Welcome to Opalesk TV. Today I'm in Austin, Texas, together with Bryan Johnson. Bryan runs a company called Johnson and Company, where he is dedicating his efforts to emerging managers and family offices. Bryan, tell us a bit what you are doing and how you get started in this industry.
I'm Bryan Johnson. I'm Managing Director of Johnson and Company. Founded Johnson and Company in 2010. In that 4 years, we focused on sub-institutional hedge funds. From my background, I've been in the alternative space about a little over 25 years. Worked inside of 2 family offices, founded and started a family consultancy. We advised about 63 families on asset allocation and manager selection for alternatives, so that spanned private equity as well as hedge funds and some more exotic areas like numismatics and antiquities. I also represented the state of Texas and the Office of the Attorney General as expert witness and lead consultant in the 2% per energy, where I evaluated hedge funds and private equity firms, and also was global head of sales, marketing, and business development for a financial services firm that was focused on the alternative space in deploying an operational risk product for bulge bracket hedge funds. I started Johnson and Company again in 2010 because I saw a problem in the alternative investment space from a new manager perspective. If you look at the data, almost 89% of all managers never get over 100 million in AUM. And that's despite outperformance in most instances. So I thought that there was a problem. Raising assets in this environment is quite challenging. And the principal reason why it's more challenging is most managers do not have a structured, disciplined, and focused marketing process. And generally that's because of 3 reasons. The principal reason is most managers believe that the allocation decision is a one metric criteria, that it's all about performance. And there was a time that used to be true. What I like to refer to managers is that we're dealing with 2 time frames. There's BC, which I refer to as before the credit crisis, and AD, which is after the death of everything, principally trust. And in BC, promoting pedigree and performance were the principal ways of raising assets. However, in AD, process articulation, clear, consistent, concise, compelling, regulatory compliant process articulation is the key to raising assets in this environment.
Bryan, when you work with emerging managers, what are some of the most common mistakes that you see that ultimately may lead to failure?
Well, I think there are 3 principal mistakes that managers kind of come to the decision to start a business with. And that's the first one, that they don't realize that they're starting a business. The fund is encapsulated in the business. So that's number 1. They don't think of their fund as a business and a growing business. Number 2, and probably alongside of number 1, is the thought that, the allocation process is all about performance. And I'm always telling managers that performance gets you attention, but it doesn't get you an allocation. So that's the second big mistake. And the last thing is they do what I refer to as chase institutional unicorns. They go after investors that are not appropriate for them, given their fund profile and where they are in their life cycle in the maturation process of a business. So a lot of them go after institutional investors when, in fact, they should be more focused on single-family offices, multifamily offices, ultra-high net worth individuals who have always been historically the target in the most ideal segment for the new or emerging manager. And also, people underestimate that market. In fact, they don't really quantify the opportunity set very well from a tactical marketing standpoint. And that's one of the things that we get managers to really focus on. What's the real opportunity set for them? And if they don't have a clear understanding of that, then what happens is their message is inappropriate. So they're sending the wrong message to the wrong target segment, and they really have chronic failure raising assets at that point. So also understanding the length of the runway, and as I said previously about the different time frames that we're operating now, BC and AD. In BC, the runway from initial interest or introduction to ultimate allocation was significantly shorter than it is now. I think on average then it could have been anywhere from 6 to 9 weeks, and that was in BC, which is before the credit crisis. However, now, because due diligence has been protracted strategically, tactically, and temporally, meaning that strategically, investors and intermediaries are looking at more things. Tactically, there are more people involved in the due diligence process. I think if you look at where the resource allocation has been on the buy side of the equation, where it's been in analytics, it's been in staffing in order to really assess managers holistically. And then finally, that's devolved into there's this temporal expansion in the allocation process. So what used to take maybe 6 to 9 weeks from interest to ultimate allocation now can be anywhere from 11 to 18 months. So therefore, if you don't have a process to really build and nurture a relationship with an investor over that elongated period, you're going to have a very difficult time raising assets in this environment. So I think managers underestimate the length of the runway and also the difficulty in getting the attention of the right investors. I mean, investors are inundated, with information now. And it's hard to distinguish between the contenders and the pretenders and what's real, the meat of it and what's just noise. So it takes a lot of process, and you have to have an investor-centric process in order to identify the right investors and appropriately engage with them, again, through that long, elongated runway.
So Bryan, you're intimately familiar with the family office universe in Texas and the U.S., given your background and your work experience. Tell us, what are managers missing here?
I think initially it's probably good to kind of just quantify what that universe looks like. And we could start in the big picture here in the United States and then kind of bring it down at a more granular level here in Texas. If you look at the United States as a whole, there are about 55,000 plus individuals and families with a minimum net worth of 50 million, and that's growing at a compounded annual rate of 16%. And when you sit down with managers and you really kind of explain to them the breadth of that opportunity, what I call the individual market. And individuals are individuals and families that have asset levels on par with a small institution. So when you sit down with managers and you kind of really give them a picture of what that market looks like, most of them are really taken aback and have no idea that was how expansive the market really is. So the other thing about that market is it's idiosyncratically demanding. Unlike institutional investors, which have a very homogeneous kind of profile, and that's by design, because there are consultants involved, and they all kind of are looking at the same problem and trying to handle the same similar problems in a similar way. Families and individuals are categorically different. Structurally, they're different. So when you meet one family, you can't really apply what you've learned from that one family to the next family. So they're idiosyncratically demanding. So when you bring that big number down to Texas, here in Texas, there are about 9,500 individuals and families that have a net worth in excess of 50 million. So it's a very, very rich base of investors. But the challenge is reaching those investors appropriately and identifying those investors. So what most managers need to do that they're not doing is approach the whole marketing process with a greater degree of intelligence, and therefore using analytics to really identify your target market, identify the appropriate strategic individuals and organizations within your target market, and then have a customized engagement strategy. And I know this sounds like a lot when managers are starting out, but unfortunately or fortunately, that's the time. Those are the times that we live in. The barriers to entry have increased. The cost of just startup has increased. The regulatory environment is more dynamic and more interventional now than it ever has been for managers. And so part of that is operating your entire business with a greater degree of intelligence about how to market and how to raise assets. Because aside from trading, which is the bread and butter, the marketing and raising assets and the retention of those assets are the most critical components to the success or failure of your business. If you don't consistently have a process in place that you execute at a high level to raise assets as well as retain them, you won't be in business for long. So having that process and thinking about it intelligently, thinking about it comprehensively is very, very critical to the emerging manager. I mean, those first 3 to 5 years where you're getting up and running and trying to get over the hurdles that you need to get over are very critical. And I think, if you look at the research and you say, as I said earlier, 89% of all managers never get over 100 million AUM. And those that do, it takes on the average 16 to 18 months to do so. If you go to the further end of the spectrum, where you look at those managers who are fortunate enough to have gotten over $1 billion, only 3.7% of all managers get over that hurdle. And it takes on the average anywhere from 55 to 57 months for them to do that. And that's on a study of over almost 18,000 managers. So it takes a while. You understand the runway to come from that initial startup through the maturation process of becoming a franchise firm. And it takes a process to get from A to B. And that process is not linear. There are some fits and starts, particularly in the early stages. And what we try to do is, if you have the right process, is to minimize the fits and starts, the back and forth, and make the process as progressive linearly as we possibly can.
So Bryan, when you work with an emerging or smaller manager, what does your process look like? So what do you do with that company?
We've identified three critical areas that a manager should focus on if they're serious about achieving success raising assets. And that's strategic, tactical, and financial. And strategically, it's basically what you're saying, how you're saying it, who you're saying it to. Tactically is execution. It's making sure that you're engaging with the right investors, the most ideal and most suitable, given your fund profile, and you're doing that appropriately. And finally, the financial component, the nuts and bolts of it takes money to market and raise assets. And what we initially do is go in and do a forensic and diagnostic assessment of the ability of a manager to raise assets and market. So do they have a process in place? What's their ability to execute? Is it consistent? Is it flawless execution? Because that's what it takes. So we do that, and we identify areas that may need remediation in the process. And then the second step of that is we develop the process and remediate areas that are necessary. The final component, financial, we construct the appropriate budget for them to market in order to achieve their goals. I think that's one of the areas that managers really don't have an acute grasp of the financial implications. And if you look at the research we've done and people have done externally, it takes about 40 basis points per million to raise assets from private wealth. It takes about 70 basis points per million to raise money institutionally. So you're looking at probably somewhere in the neighborhood of a minimum of 100 to probably 200,000 on an annual basis to support your marketing. And most small funds or sub-institutional funds don't have a clear understanding on a granular basis of what the financial implications are for them to achieve their AUM goals and sustain that going forward. So we try to add a measure of kind of quantitative rigor to that. We do a lot of research in all the aspects of marketing and fundraising in order to give managers some concrete data and metrics to point to as to what they should be achieving from a process standpoint. And it kind of to strip out more of the subjective, if you will, approach that managers take. Again, it defaults back to all I need to do is put up numbers and the world's going to be the path to my door and raise assets. And again, as most managers find out after a significant period of time, that that approach really doesn't work. One of the things from a financial standpoint in marketing is that we get managers to focus on their geographic and relational footprint. So, and if you look at the data, the research we've done, that any marketing trip or marketing opportunity that's within your geographic footprint, we kind of classify that as anywhere you can go in the morning and be back in the afternoon from a drive, sleep in your own bed at night, on the average cost between $275 and $325. Any marketing trip that's outside of your geographic or relational footprint generally is anywhere from $2,750 to $3,250. So it's a significant increase in cost of marketing if you go outside of your geographic and relational footprint. So again, to go back to the tactical aspect, when you quantify your opportunity set appropriately, it allows you or enables you to have your marketing spend be more intelligent and be more prudent. You're not running across the country or around the world to this conference or that conference because you don't really have a clear understanding of how to raise money within your geographic and relational footprint, what the opportunity set is like. So there's significant financial implications if you don't approach the marketing process and the marketing challenge with a higher degree of intelligence.
So Bryan, from your experience, what are the true catalysts that eventually lead to an allocation decision?
As I said before, I think most individuals and families are idiosyncratically demanding. So the true drivers will vary individual to individual, family to family. So from a marketing standpoint, it's very critical that a manager have a very clear and deep profile of an investor. And what we try to do is construct a holistic picture of that investor, who's involved in their allocation decision. It's not just one person, particularly if it's a family office. They may have a CIO, they may have a matriarch or a patriarch that's involved, they may have generational issues that are involved in their decision. And also it may be from a standpoint of what is their wealth create, what was the source of their wealth creation. All these different things vary family to family, situation to situation. So when you are trying to determine what the true allocation drivers are, it requires that a fund do a significant amount of homework prior to sitting down initially with that individual or family. So one of the things that we advocate very clearly is, as I said before, profiling your investor. So how much information do you know about that investor before you sit down? What have they done before in your space? Have they allocated to early stage managers before? What's been that experience? Have they allocated to the strategy before? What's been that experience? Because those things are going to really be the significant drivers ultimately in the allocation decision. One of the most difficult things for anyone to do is something they've never done before. So if a family or an individual has never invested in an early stage manager previously, the hill to get them to that point is going to be significantly steeper than a family that has a core competency or a history in evaluating managers, early stage managers, investing in those managers, and has done it with a great degree of success. So understanding who you're sitting down with is critical to then identifying those idiosyncratic drivers on a case-by-case basis. Clearly, there are some top-line things that are common to families, and I would say there are two top-line issues. Every family is focused on protection and performance and how that plays out in the perpetuity of their wealth. So because every family has generational issues. They want their wealth to last generations. So the protection and their performance are kind of top line ways in order to get to that. So from there, it's really incumbent upon the manager to do some digging and approach the whole allocation process in a more consultative manner. It's not just, well, let's meet, this is my strategy, this is my performance, then you should give me X dollars from an allocation perspective. If you have an investor-centric marketing process, it's all about understanding where you fit in their world and in their asset allocation. And if you don't do that, then you'll be constantly trying to possibly fit square pegs in round holes if you don't have a clear profile and understanding of who you're dealing with, and again, what the true drivers are. So I would say to managers, realize that when you're dealing with an individual or family, that the drivers are highly idiosyncratic. They're unique one-to-one. So think of the snowflake kind of phenomenon. If you know two snowflakes are the same, no two families are the same, no two individuals are the same. So go in with that consultative attitude initially. And there's some things that we kind of coach managers on doing. And we have what we call a 2-2-1 strategy, which is you have 2 eyes, 2 ears, and 1 mouth. So you should be listening and observing twice as much as you're speaking in the initial phases of sitting down with an individual or a family. That way you're in the information gathering mode in order to then determine whether or not only are you a right fit for them, but also are they a right fit for you. So being very selective in how your investor base is comprised, and I think one of the things that's really came out of the credit crisis is that investors are more aware of the adjacency risk in the commingled funds, which is one of the reasons why you've seen a proliferation or an increase in use of separately managed accounts. People, for transparency, control, litigious reasons, the separately managed account kind of vehicle gives you an optimum way to protect yourself and control and have custody of your assets. And also, who else is in bed with you? I think, when you're in a commingled vehicle, as some families were, and experienced some, investors who became co-investors who became potential litigants, they're very aware of that. So, you've got to understand, again, who you're dealing with, what are the drivers on their part, and that takes a significant amount of digging. It's not just showing up at a meeting in order to pitch your fund. It's really showing up at a meeting and interviewing the people that you're going to be sitting down and gathering information in order to kind of, again, make sure that you're in front of the right people and that you're engaging with them in the right way as you go through this elongated runway.
So Bryan, all in all, it looks like that managers really heavily underestimate what's involved with getting allocations and being on a growth path.
I think that's absolutely correct. They far underestimate what it takes, not only qualitatively, but quantitatively. So there's 2 aspects of engagement. There's qualitative engagement, which is, how are you reaching them? And then there's the number of times that you reach them and touch them. From a quantitative standpoint, most managers severely underestimate that. It takes on the average anywhere from 150 to 200 meetings to get anywhere from 3 to 5 allocations, which can be a very sobering kind of number for most managers to kind of wrap themselves around. But in this environment, that's what it takes, because ultimately, if you reach out to anywhere from 10 to 15 people, that may result in maybe 1 quality meeting, and over the time, that close ratio of ultimate allocation is anywhere from 5 to 7%. So you can see it takes a very dedicated, outreach process and engagement process quantitatively in order to really achieve your AUM goals going forward. Most managers are very low on the quantitative engagement. They may go to a conference here, they may meet somebody here. It's not a consistent kind of approach in order to reach that 150 to 200 meetings annually in order to make sure that the AUM is coming online consistently. Because the other derivative of that is that also allows you to retain assets as well as acquire them. So asset retention is almost as critical as asset acquisition. And a lot of managers in their early stages, because they're so focused on the acquisition of assets, their retention of assets and the process to retain them goes lacking. Because most managers believe that the performance is going to be their retention kind of strategy, when in fact, performance does not always retain the assets. And in fact, if you look at the data, performance is, I think, number 3 in the aspects that retain data. Transparency, communication trump their performance. So if you're communicating and you're transparent through good and bad performance, and every fund is going to have good and bad performance periods, but it's your ability to communicate at a high level and provide that transparency that investor or that intermediary needs, which will ultimately maintain your asset levels. So I think managers need to understand, that as well. The other thing too that I would like to add in is that marketing has to be seen in a broader term now. Investors, intermediaries, other market participants are more educated and informed now post-credit crisis than they ever were before. So making sure that you have a consultative and educational process that is critical for, again, the acquisition and the retention of the assets that you're trying to bring on board. People want to be educated. And as you're educating them through your process and how you do it, you're really building the right relationship. Because you don't want to get into a situation that a lot of funds found themselves in prior to the credit crisis, that fast in, fast out, meaning fast in allocations, first out allocations. So one of the things that happens, the longer the process, the better the relationship that is built, the more sticky the assets become. Because on the investor side of the equation, investors are now expending enormous amounts of money and time and resources evaluating managers, making sure they have the right manager. That's not a situation where they're going to be pulling out of or filing a redemption or submitting a redemption request shortly after making the allocation. They've gone through too much in order to make it, and they can't afford to really have that in and out. I mean, it does, in certain instances. I think the more liquid strategies, and you see more like in Europe, you have UCITS and that promote that kind of liquidity. But here in the States, for the most part, you're in a commingled vehicle or you're in a separately managed account that you've done a fair degree of due diligence on and committed a lot of financial and temporal resources on, and you don't want to just pull out of that, and you don't, because the switching costs are just too high to do that. So I think managers need to understand that the quantitative engagement is critical. Measuring that engagement, how many times are you touching that particular investor? Do you have your finger on the pulse of what they're thinking and who's involved in the decision making? How are you engaging with them? So it becomes more than just, I'm going to reach out to this end user. It's how do you reach out to the ecosystem around that investor in order to then gain that degree of holistic, actionable conviction, whether it's the end user, whether it's the intermediation point, whether it's other strategic advisors that are involved in the decision, in order to all to come together to have that actionable conviction level that this is the right firm, these are the right people or the right person, let's make the allocation, let's go forward. So, marketing now, again, has taken on a broader role. There are more things involved in the decision from the allocation standpoint, so managers should be approaching their marketing in that particular way as well. And if they don't, they're not going to have success. And unfortunately, the stats bear out that there's a disconnect between what managers are doing and what investors are seeking from an organizational standpoint and a marketing standpoint. And that bears out. If you look at fund flows, asset flows, most of the assets are going to the larger, funds, and that's not because they're outperforming. That's just because they have a mature process in place operationally And I think, if you look at the operational spectrum, there's really 3 stops on that spectrum. Most early stage or sub-institutional managers start out with being minimally resourced, where investors want them to be optimally resourced. So there's a middle ground that needs to be achieved where the fund and the investors agree that they're appropriately resourced given their stage in the maturation process. And there's some tension around that, particularly, for those funds that are going institutional. Again, institutional investors want you to be optimally resourced. They want strength through redundancy, and smaller managers simply can't afford to do that, and they're not at the position to do that. So making the case in your marketing that you are appropriately resourced, that you have the checks and balances in place in order to provide not only performance, but the operational protection that that investor needs and wants and should have, is incumbent upon the manager. And if they don't do that well, again, it's going to result in chronic failure raising assets going forward.
So Bryan, from your experience, from your understanding, what are the top 2 criteria, the top 2 factors that a, let's say, emerging manager needs to bring to the table in order to succeed?
Well, I think that the first and foremost, the most important thing that a manager needs to bring, or an individual needs to bring, is the commitment. An understanding of the holistic enterprise-wide commitment that it takes in order to make the business successful. You're not operating a fund. You're operating a business. And I will tell you, when we sit down with a manager, and I sit down with a manager initially who's even contemplating a fund, and also with those who have already launched, who are having some chronic difficulty, the initial discussions that I have with them are, okay, do you understand the commitment necessary? And probably in 25% of the cases, I'm very candid with them and say, I don't think you should be operating a business. You're a great trader, and that doesn't mean you're going to be a great business owner. So perhaps you should just go trading your own account or family and friends' money and leave, the rest of that alone. So the first thing is to have a clear understanding of what that commitment is. And then secondly, once you understand, that you're ready to make the commitment, you understand it, how to focus on what we think are the critical areas, and we kind of distill that down to 4 areas that you should be focused on, which is enterprise management, business management, sales, marketing, distribution, operations, and of course, your investing process and ability. So if you need to kind of look at those 4 areas, make sure that you have best practices and best of breed service partners involved. And that brings me to a very critical, kind of distinction between a service provider and a service partner. In my opinion, smaller sub-institutional funds need service partners more than they need service providers. And how I make that distinction between the part provider and the partner is that our partner approaches the relationship with a sub-institutional fund in a more consultative manner. That they preemptively look at the landscape and say, how do we help our client, achieve their goals effectively, efficiently, economically, and how do we preempt them from getting into the potholes of things, as opposed to a provider who's basically just responding to requests that a manager or an individual may make. So there are firms across the spectrum, whether they be accountants, whether they be fund administrators, whether they be lawyers, technology providers, who are clearly in the service partner bucket, as well as there are those who are in the service provider. But I would urge managers to really kind of go through a process of interviewing and sitting down with people to determine where they are. Because in the initial phases, in the initial kind of stages of the maturation process, that first 36 to 48 months, it's like drinking from a fire hose. There's so many moving parts. It's a daunting thing to get your business up and running and making sure it's successful while you're trading at the same time, or you're doing whatever investing you're doing. So having a service partner who can, take some of those operational or administrative burdens off of your plate, or if they can't do that, to help you handle those things more efficiently is going to be critical in your success going forward. So, but again, to back up, I think, again, the initial conversations that we have with people before they even become a client is trying to ascertain, do they have an understanding of the holistic commitment that's necessary to be successful, and querying them with the appropriate questions to kind of help them arrive at that point on their own, as opposed to me saying to them very candidly and directly, I don't think you should be doing this. You need to do something else.
So Bryan, this just sounds like a huge amount of work that needs to be done when it comes to marketing of a smaller fund, of an emerging manager. So at what point do you recommend a manager to have a dedicated investor relations person, or are, let's say, third-party marketers an option?
Well, I think that managers should start thinking about marketing well in advance of even launching. Unfortunately, most managers don't, because they believe that the marketing effort is all about putting up performance and distributing performance data. So ideally, they should have a series of intelligent discussions before they even launch. Having said that, most don't. When they should bring on somebody who can handle some of the qualitative and quantitative aspects of outreach and investor relations is as soon as they possibly can. And they don't have to bring on somebody who's a full-time dedicated person. There are certainly strategies and mechanisms they can use in order to do that, to get around that full-time dedicated person. But if they have a process in place in order to kind of that understands what the outreach levels should be and those kind of things. When they should take on a full-time person is, again, as soon as possible, but ideally it should be at the cusp of what I refer to as the institutional threshold. Once they get to 150 to 200 million, they really should take on somebody internally on a full-time basis, which can be expensive, but it's an investment in your business at that point, because their investor base will broaden. They can look at different aspects, different types of investors. So at that point, they need somebody who's going to be out there full-time, engaging in acquisition as well as retention of the AUM. Once they get to, I would say, the 250 to 300 million level, and again, the investor base broadens again, they might think about engaging a qualified and reputable third-party marketing firm in order to penetrate, specific segments. And then there they've got kind of a full complement. They've got an internal marketer who's handling some of the areas that they have core competency in. Could be further extending their footprint into the single-family office or multifamily office segment, or independent RIAs, which I think is a very compelling investor segment or distribution segment going forward. And then they also, when they get to that sweet spot of anywhere from 350 million to about $1 billion, they can think about engaging a qualified, reputable third-party marketing firm. But again, if they come to the marketing discussion early on, they have a real clear sense of what's appropriate when and what their true marketing options are from a tactical perspective. If you don't have that, then you're going to make a lot of mistakes in who to engage qualitatively. What types of firms are best for you? There are certain segments where, a pension fund, for example, for the most part, won't engage with a third-party marketer, because there are some, issues that have been in that space, and part of addressing the problems in there is to, make sure that funds are coming directly to the pension funds, devoid of the third-party marketing relationship. So I think a fund needs to get a really clear understanding of the true marketing options on a tactical basis, and then that will lead the development of a process, and then from there, the ultimate engagement with qualified, reputable parties going forward. As an aside to that, there seems to be some kind of fallacy around the option of third-party marketing for sub-institutional funds. And we did a study about a year and a half ago that found out, we did a study of around 300 placement agents and third-party marketers, that one out of every 275 sub 250 million AUM managers gets a third-party marketing relationship. It's a very small universe. And generally, the third-party marketers who are working with those 40 funds really look similar. They come out, there's usually a spin out from a larger firm or a larger fund. For the vast majority of smaller funds, the marketing and fundraising responsibility solely resides with them until they reach that minimum institutional threshold, which makes the acquisition and execution of a marketing process even that more important. Because if they don't have that, then generally what happens is they have this ad hoc approach to marketing. So they generally default to the thing that they feel most comfortable with, which is trading and investing. And that is not really, in that performance is not bringing in the AUM as they thought it would. Some of the other things that they do without process is they generally post their performance to popular databases, hoping that people will identify the fund. And for individuals, those single-family offices and ultra-high net worth individuals that I referred to earlier, that's not where they go to look for managers. If you look at the data, less than 10% of individuals in single-family offices go to online databases to identify managers. So when you understand that, you'll understand that may be a reason why now you understand why you're not raising the assets as you thought posting performance to a popular database was going to bring in assets. The other thing that people do is without the benefit of a structured, discipline-focused process, they do what I refer to and what many refer to as spray and pray. They send out lots of emails to family offices. They'll get a list of family offices and send out their performance data or a deck. And generally that doesn't even get looked at. That comes in over the transom. It comes via lack of a relationship. And generally, particularly in the family office market, they're very sensitive to relationships, and you need a quality introduction or a quality means to get to them. They have to be able to track you, where'd you come from? And they can't afford not to do that, quite frankly. The reputational risk is quite high for all investors, and particularly for family offices. So they're very, very keen on, the qualitative introduction. So if you don't have a process, you really succumb to a lot of unstructured, ad hoc, inappropriate behavior from a marketing standpoint that ultimately results in chronic difficulty and failure raising assets.
So Bryan, you're doing this consultancy work now in your 5th year, and you have worked with about 300 funds so far. What has been your biggest takeaway? What has been your biggest lesson in doing that?
I think that the biggest takeaway is that there's a small minority of funds who understand the climate that we're in, and they are the ones that are adopting a marketing process early on. The vast majority, unfortunately, still believe that it's performance that will gather and bring in assets. And they are the ones that really kind of take a long time. And in fact, over the course of working with about 300 funds since 2010, it generally takes about 2 years before a fund will, despite their performance, will say, hey, maybe we need to do something about marketing because we don't have a process in place. But that group is diminishing, or should I say growing glacially. But they're in a distinct majority, the ones that still believe that it's all about performance. And in fact, I was at an event a couple weeks ago, and I was speaking to somebody, and they said, well, hey, it's all about performance. If you look at the data, and this is an important piece of data, the top performing funds never raise as much money as the top asset gathering funds. So the top asset gathering funds are not necessarily the top performers. And in fact, the top asset gathering funds raise 4 times as much money as the top performing funds. So if it was all about performance, that would be flipped over. So if you think that it's all about performance, then the asset flows wouldn't be going as they are now. And since you look at the data as well, that most emerging managers outperform the larger managers almost by a factor of 2. There's about 400 extra basis points, almost a double, in their ability to generate alpha. They should be getting more assets than the poor performance if it was all about performance. And that's not the case. So in that kind of runway, that 2-year runway, somewhere toward the middle of the end of year 2, they finally say, if we don't have a marketing process to appropriately engage, which is probably the reason why we're not having success, raising assets.